Two sides sit across a mahogany table, pens in hand, papers ready to sign the long-awaited ceasefire. The world watches, hopeful that maybe, just maybe, peace has a fighting chance. Then in the next breath, jets scream across the sky. Missiles tear through the night and hit the very city hosting those peace talks. Doha, Qatar. It sounds like fiction, like a plot twist ripped from a political thriller. But that's exactly what happened when Israel launched an airstrike on Qatari soil, right as Hamas negotiators were meeting under Qatar's mediation. In a single moment, diplomacy was not just suspended, it was bombed. This wasn't just another chapter in the endless Middle East saga. It was a move that shook the entire board, because Qatar wasn't a combatant. It was the referee, the mediator, the country hosting one of America's largest military bases, where over 10,000 U.S. troops are stationed. So when Israel's missiles fell on Doha, it wasn't just a message to Hamas. It was a slap in the face of both the mediator and the superpower behind the stage. Why did Israel risk everything for one reckless move? What kind of strategy bombs a peace table and calls it leverage? And what price, political, diplomatic, and economic, will follow this explosion in trust? Stay with me till the end of this video, because what you're about to hear isn't just a war story, it's a warning about how one perfect strike can detonate years of alliances in a single night. Start with the map. On one side, Israel, a tech-fueled, wartime economy of roughly 10 million people, GDP in the $500 billion range, famous for unicorns, semiconductors, cyber, and a defense industry that exports know-how the way others export coffee. On the other side, Qatar, a tiny peninsula with giant leverage, among the world's top LNG exporters, per capita income in the stratosphere, and a diplomatic switchboard that has connected Washington, Hamas, the Taliban, and half the region at one time or another. Since late 2023, Israel has operated in a permanent crisis tempo. Mobilization pulls hundreds of thousands out of the civilian workforce. Tourism thins. Consumer confidence seesaws. The shekel has had its roller coaster moments. The fiscal deficit widens with wartime spending, and big credit rating houses have at minimum put up flashing caution signs. Yet Israel's economic engine still hums in places. Gas from Leviathan and Tamar keeps flowing. Late-stage startups still raise money, with more haircuts, and defense orders stack up as if the industry just got a grim global marketing campaign. Qatar, meanwhile, plays three boards at once. Board 1 by Energy, long-term LNG contracts with Asia and Europe give Doha a cash gusher and geopolitical insurance. Board 2, Security. The Al Udeid Air Base hosts a massive U.S. presence, effectively wiring Qatar into the Pentagon's map of the Middle East. Board 3, Mediation. Doha's brand is, we pick up the phone when nobody else does. That brand requires neutrality optics, predictable airspace, and trust that its soil is off-limits to theatrics. Economically, these worlds intersect. Israel's tech sector and defense exports plug into Western supply chains. Qatar's LNG literally heats European winters and powers Asian factories. When the two clash, not on oil prices or gas contracts, but on sovereignty and mediation, it's not just political temperature rising, it's risk premia, shipping insurance, and portfolio rebalancing. Ordinary life translation: the Israeli cafe owner who can't find staff because reservists are gone, the Qatari logistics manager who plans flight corridors assuming regional skies stay boring, the European utility hedging LNG deliveries that route through an increasingly nervous neighborhood. Add one more player, the United States, whose troops sit in Qatar while its closest regional ally sits in Israel, and you have a triangle where any miscalculation turns into a diplomatic math problem no one wants to solve on a Monday morning. So here's the tension. Israel views coercive force as a negotiating language the region understands. Qatar views predictable mediation as a national asset that must never be humiliated. Put those doctrines on a collision course in Doha, and you don't just bruise egos, you rewrite risk. Next, we dissect the move itself, why a government would bomb the room next to the conference room and call it strategy. Let's call the move by its real name: coercive diplomacy by airstrike. On paper, the logic looks cold and tidy. If negotiations are trending toward terms you dislike, you impose a cost loudly so the other side recalculates. You prove reach, sow fear, and signal to every actor at the table that your red lines aren't ink, they're etched in shrapnel. But here's the economic and strategic autopsy. First, market signaling. When a state chooses kinetic force in the middle of a mediation hosted by a U.S.-aligned capital, it doesn't just hit walls and windows, it hits premiums. Political risk premium, war risk insurance for airlines and shipping, the implied volatility baked into regional currencies. Investors translate morality plays into spreadsheets. Predictable process becomes headline hazard. The next bond auction anywhere near the story pays a little more to borrow. The next equity round prices a little lower. The next insurer recalibrates the cost of flying, docking, or building in a neighborhood where even the referee's whistle can get jammed by a missile. Second, institutional backlash. Multilaterals live on norms: sovereignty, non-escalation in third country venues, the sanctity of talks. Break those norms in a way that humiliates a mediator, and you invite the alphabet soup, IMF, World Bank, OECD forums, to apply pressure through language that sounds polite but costs real money. Heightened uncertainty, downside risks, prudence warranted. Ratings agencies read the room the same way. They don't punish moral choices, they price durability. If allies look less durable and processes less repeatable, you move from stable outlook to negative watch faster than a press secretary can schedule a briefing. Third, doctrine risk. Israel's doctrine has long fused diplomacy with credible threat. Speak softly, carry a very precise stick. But precision is not the same as permission. The strike's timing, during mediation, on the mediator's soil, converts a tactic into a narrative. That talks aren't safe anywhere. Narrative arrows metastasize. Once counterparties believe you'll upend the venue itself, they bring harder preconditions, deeper redundancies, or new patrons to future talks. All three make peace more expensive. Fourth, supply chain splash damage. Qatar's value proposition is LNG reliability and airspace predictability. Tarnish either, and you ding forward contracts, aircraft routings, and the quiet plumbing that keeps global trade breathable. The irony, you might not cut a single LNG cargo, but insurers and hedgers don't wait for the second data point. They price the possibility. That's how a 30-second strike becomes a 12-month surcharge. Why pick this path? From inside the war cabinet, the arguments sound brutally rational. 1. Remove or rattle enemy leadership. 2. Reframe bargaining from mutual concessions to your survival is conditional. 3. Prove to domestic audiences that you won't be boxed in by foreign choreography. In that room, escalation looks like clarity. Yet step outside the echo, and you see the trap. The more you rely on shock to shape talks, the more mediators matter, and the fewer remain willing to host. The more you display reach, the more partners demand guardrails before sharing intelligence, airspace, or political cover. And the more you treat a referee like a prop, the more neutral venues evaporate, until the only place left to negotiate is the battlefield itself, where prices are measured in lives, not basis points. Short-term leverage, long-term liability. That's the miscalculation at the heart of the Doha strike. History doesn't repeat, but in this neighborhood it has a habit of humming the same tune. Again and again, leaders mistake a dazzling show of strength for strategic wisdom, only to discover they have lit a bonfire under their own chair. Think back to the United States and Iraq in 2003. Shock and awe promised leverage, rapid victory, a region reshaped by momentum. For a season it looked convincing. Then the bill arrived. Insurgency, occupation costs measured in trillions, alliances frayed, and a long shadow over American soft power that colored every negotiation from Tehran to Beijing. What began as a demonstration of dominance morphed into a lesson in strategic drift. Fast forward to Russia's gamble in Ukraine. The pitch to domestic audiences was the same old melody. Strike early, bank leverage, dictate terms. Instead came isolation, frozen reserves, capital flight, and a brain drain that talent managers still describe in the past tense, because the people are already gone. The ruble's swoons weren't just currency waves, they were financial echoes of diplomatic overreach. Power projected at the border turned into vulnerability exposed at the balance sheet. Place Israel's Doha strike on that continuum, and the rhyme scheme is hard to miss. Different scale, different battlefield, but the logic is familiar. Under pressure at home and distrustful of the mediation track, a government reaches for spectacle to stiffen spines and reset the bargaining table. In the moment, it feels like clarity. In the aftermath, it behaves like corrosion. Trust bleaching out of relationships that took years to build. Partners rehearsing exit options, mediators revising their risk manuals, and quietly moving the meeting to somewhere you don't control. The sequence is cruelly consistent. First comes the surge of confidence, the belief that deterrence has been reasserted and the initiative reclaimed. Then comes the quieter damage, hesitation in friendly capitals, a cooler tone from institutions that prize norms over theatrics, a recalculation by investors who prefer boring corridors in predictable skies. By the time the dust settles, there's often a gap you can't bridge with precision munitions. Battlefield outcomes look tidy on a map, while political sustainability looks threadbare in every other room. None of this says force never works. It says force that humiliates the referee tends to bankrupt the game. Mediators are not infinite. Neutral airspace is not a renewable resource. And once a venue feels compromised, future talks arrive armored in preconditions, redundancies, and new patrons. Every layer adds cost. Every cost invites fatigue. Fatigue is where even strong strategies go to die. So the warning from the archive is simple and unsentimental. If your plan requires allies to feel expendable and venues to feel violable, you will run out of both faster than you can declare victory. Power can open doors, overreach changes the locks. Start with the nearest walls. In the next 6 to 12 months, the shock of a strike on a mediator's soil seeps into everything that needs calm to function. Airlines revisit routes and premiums. Shipping firms ask underwriters for new quotes. Investment committees rehearse the phrase, "let's wait a quarter." Israel pays more to borrow as war spending fattens the deficit and the shekel moves with headline weather. Qatar pays in reputational scuffs because a brand built on neutrality relies on the assumption that its sky is boring and its conference rooms are sacred. Neither economy collapses, but both carry a new weight. For Israel, it's the arithmetic of a mobilized workforce and elevated security outlays. For Qatar, it's the question of whether mediation can still be sold as a safe service when the stage itself was nearly set on fire. Stretch the horizon to 3 to 5 years, and the costs compound in quieter ways. Markets tolerate risk, they punish unpredictability. If Israel leans on coercive theater whenever talks tighten, partners learn to pad timelines, add conditions, and reroute sensitive cooperation through third parties. That slows trade, dulls venture appetite, and drives up the invisible tax on doing business with a country that might turn a negotiation into a spectacle. If Qatar cannot guarantee that high-stakes dialogues remain inviolable, it must spend more political capital to keep the phone lines open and may need to sweeten LNG relationships and security understandings just to restore the old trust discount. None of this makes headlines, yet it shows up in basis points, in the delta between what used to clear and what now needs a nudge. Internationally, status tilts in subtle increments. Israel's edge has always been credibility plus precision. Say little, do exactly what you signal, keep friends looped in. The Doha episode risks swapping credibility for notoriety, which is a bad trade in a room full of allies who prefer predictability to surprise. Europe becomes cooler on defense tech linkages that can boomerang into legal and political friction. Washington keeps support on substance but trims the benefit of the doubt. Every briefing grows an extra paragraph on deconfliction and venue safety. For Qatar, the mediation franchise remains valuable precisely because few others can run it, yet the margin for error narrows. To keep that franchise, Doha doubles down on guarantees, invests in surveillance and air defense optics, and leverages energy ties to remind partners that talking in Qatar is still cheaper than not talking at all. Experts will dress this in neutral vocabulary: elevated risk premia, persistent uncertainty, structural headwinds. But the translation is simple. Blow a hole in the room where people are trying to end a war, and you don't just scare your enemy, you make everyone else pay more to be in the same neighborhood. Do it once and markets squint. Do it twice and insurers write it into the price. Keep going, and even your friends start budgeting for distance. The drama warning is this: blast waves travel farther than the smoke column suggests. They move through norms, contracts, and calendars. They bend the path of money long after the crater is patched. You can win a night and lose a decade if the victory teaches your partners that proximity is peril. Begin in the Gulf, where reputations are currency. Qatar's mediation brand depends on neutral corridors and predictable skies. Scratch either and neighbors feel the breeze. The UAE and Saudi Arabia read the episode as a reminder that even sophisticated air defenses and U.S. ties cannot sterilize politics, so they hedge harder. More bilateral security understandings, tighter venue protocols for any quiet talks they host, and a cooler appetite for public gestures that could entangle them in someone else's feud. Egypt, forever the pressure valve for Gaza, recalibrates border posture and contingency planning for displacement risk, because every shock in the Strip lands eventually on Cairo's desk. Energy is where the tremor gets amplified. Qatar's LNG is stitched into Europe's winter math and Asia's baseload. A perception that mediation venues are violable does not shut cargoes, but it lengthens paperwork, raises war risk premia, and nudges buyers to overhedge volume. That overhedging tightens spot availability when a cold snap or refinery outage hits, and a routine supply squeeze becomes a price spike with a geopolitical subplot. Shipping underwriters fold new assumptions into routes crossing the Strait of Hormuz and air corridors that stack over the Gulf, and pilots prefer detours that cost minutes per leg and millions per quarter. None of it is dramatic, all of it is expensive. Financial flows translate drama into decimals. Regional sovereigns pay a touch more at bond auctions until the narrative stabilizes. Fund managers trim exposure to names most correlated with headline risk and reweight toward boring dividends that sleep through news cycles. If Israel signals that coercive theater is a standing option, the shekel trades with a thicker fear premium around diplomatic milestones. If Qatar must prove its stage is safe, it spends more soft power to keep talks in-house and counters with deeper energy partnerships to anchor confidence. Banks and venture funds from London to Singapore quietly write new clauses about venue safety and force majeure into term sheets, because even tech deals dislike turbulence. Security geometries shift too. The fragile scaffolding of normalization, the web of trade offices, tourism pilots, defense MOUs, relies on the belief that tomorrow looks like today, with fewer surprises. A strike on a mediator's turf plants the opposite idea, so the public choreography slows while the private channels multiply. Turkey sees room to re-enter as a fixer, Iran sees proof that Washington cannot always police its friends, and Washington sees a future of more deconfliction calls and less discretionary patience from European allies who must explain each headline to parliaments and energy regulators. Contagion in this story is not a bank run, it's an attention tax. Each actor pays in a different coin: airlines in fuel and routing, utilities in hedges, treasuries in basis points, diplomats in sleep. A single miscalculation in a city built for talks can drape a cost curve over half the planet, and the bill arrives long after the smoke clears. There is a way out, but it begins with the hardest admission in strategy. Leverage that burns your bridges is not leverage, it's a countdown. The repair job starts with choreography, because process is policy in this neighborhood. Jerusalem needs a public reaffirmation that third country venues are off limits and that deconfliction with hosts is not a courtesy but a rule, the kind that survives cabinet turnover and battlefield mood swings. Doha needs to turn the page without turning the table, which means tightening the optics around venue security and airspace assurances while keeping its most valuable export, access to everyone, untouched. Washington, sitting with one hand on Israel's shoulder and the other on Qatar's, has to do what superpowers dislike: speak softly in public and loudly in private, tying tangible incentives to behavior that restores predictability rather than theatrical surprise. From there, fix the plumbing that money flows through. Insurers and shippers price fear when rules look fuzzy, so make the rules unmissable. Publish clearer protocols for mediation security, route sensitive delegations with redundancy, and embed liaison cells that guarantee the right people talk before the wrong buttons get pushed. The point is not to choreograph the politics, it's to shrink the space where misread signals become expensive headlines. Quietly, you pair that with economic de-escalators. Israel leans into transparent timelines for mobilization drawdowns and wartime budgeting, so markets can see a path back to normal staffing and narrower deficits, while Qatar uses its LNG leverage to anchor long-dated partnerships that say, in the most credible language on earth, that stability pays better than spectacle. If those repairs take, you get the best road, the one where everyone keeps face and the system relearns boredom. In that version, the Doha strike becomes a cautionary footnote. Israel signals that coercive options remain but are fenced away from mediators. Qatar upgrades the shield around its role and proves it with uneventful quarters. The United States cashes in credibility by preventing the sequel rather than narrating it. Financial markets reward the silence. Risk premia bleed lower, airlines unwind detours, LNG buyers stop overhedging, and the conversation returns to growth, not headlines. It is not romantic, but stability never is. If repairs only half hold, you get the middle road, where the show goes on, but with thicker guardrails and thinner trust. Talks resume, yet every round comes wrapped in extra conditions, extra escorts, extra insurance. Israel still reaches for pressure in tight corners, but partners demand more transparency before they sign on to anything delicate. Qatar keeps the mediation franchise, though at a higher operating cost and with a smaller margin for error. Money flows slower. Insurers cut premiums grudgingly. It works until it doesn't, because friction accumulates in quiet places. If nothing really changes, the worst road appears, and it doesn't need a headline to announce itself. Mediators become reluctant landlords who rent out rooms with steel doors. Allies turn risk managers who ration proximity, and every negotiation migrates toward back channels that carry less legitimacy and more chance of misfire. Israel wins nights and loses narrative, paying more in basis points at home and goodwill abroad. Qatar keeps selling gas, but spends a rising share of its political capital proving the stage is safe, which is another way of saying the stage no longer feels safe by default. Markets stop giving the benefit of the doubt. Insurers write the fear into the price. Diplomacy gets tired. Tired diplomacy rarely ends wars, it extends them. The choice among these roads is not philosophical, it's operational. Do the hard, boring work of rebuilding predictability, and the system will pay you back in cheaper money and quieter skies. Skip it, and even victories will come with invoices you can't negotiate down. When the smoke clears and the markets stop twitching, what remains is not a tally of who fired or who flinched. It's a measure of trust, that invisible currency stronger than oil, gold, or gas. The Doha strike proved how quickly it can evaporate. One night of precision bombing unraveled years of quiet diplomacy, turned an ally's airspace into an open question, and reminded the region that even the most disciplined powers can stumble when they confuse shock for strategy. Israel now stands at a crossroads between deterrence and dependence. Each show of force earns a round of applause at home, but a wince abroad. And that gap is getting expensive. The shekel trades with more nerves, investors double-check exposure, and the world's patience for exceptional circumstances grows thinner. Qatar, meanwhile, has learned the curse of proximity. Being close enough to mediate means being close enough to burn. Yet it will keep doing the job because someone must, and because its soft power, like its LNG exports, is a resource too valuable to idle. The larger lesson outlives this crisis. In an age where every drone strike trends before the briefing ends, power isn't just about range or payload, it's about restraint. The countries that last are the ones that can make restraint look like strength, predictability look like pride, and diplomacy look like a business worth protecting. So maybe the next time a room full of men with maps decides that a missile will send a message, someone should ask to whom and at what price. Because markets have memories, allies have thresholds, and even superpowers run out of second chances. If you've watched this far, you already know the rule that outlives every war story. The moment you bomb the conversation itself, you stop controlling the narrative. And if you found this breakdown useful, don't forget to like, share, and subscribe. We'll keep untangling the money, politics, and power plays shaping the world, because in geopolitics, just like in finance, what explodes today always leaves a debt tomorrow.